This is the Growth and Value Podcast, empowering and inspiring stock investors, helping you take control and make a difference with your investment dollars. Looking for quality stock tips? Well, we may or may not be talking about Apple. We may or may not be talking about Google. We may or may not be talking about Disney. However, since we use our proprietary algorithms to screen, analyze, and rank over 6,000 stocks every week, we will be talking about timely investment opportunities. So you may often hear the name of a company you haven't heard of before, and you know what? That is often the best kind of opportunity, an opportunity to get in early before the investing masses. The Growth and Value Podcast is made possible by Connor Management Group, a registered investment advisor firm. Hi everyone, this is Matthew Connor with Connor Management Group, and this week we're going to look at the best growth stock to buy right now. Today is Tuesday, March 24th, 2015, and on the opening slide we see that this company is in the railroads industry, and we see its 6-month upside potential at 27.3%. On to the next slide. We see that the name of this company is called the Greenbrier Companies, and its ticker symbol is GBX. Once again, the industry this company is in is railroads, and we see its 6-month upside potential at 27.3%. Now, if you've been a regular listener of this podcast, 30 days ago, we did cover the Greenbrier Companies, and we covered it then as the best small cap stock to buy right now. But it turns out that, based on our algorithms, this is what's come up as the best growth stock to buy right now. So what we have on the next slide is an update slide to compare today versus 30 days ago. So here on the next slide, it says update. And on the left side, we have back on February 24th, 2015, when we did the original review of the Greenbrier Companies, the stock price was $58.65. Today, the stock price is $56.98, slightly lower. 30 days ago, the price target was $78.31. Today, the price target is $72.26. Again, slightly lower. Well, maybe a little bit more than slight, but lower. And the upside potential target we had at 30 days ago was 34.0%. And today, with the lower price target, this company has a 6-month upside potential of 27.3%. Still pretty appreciable. So since we covered this company only 30 days ago, we wanted to present this update slide, and then we're going to present now going forward the prior presentation. So, just be aware that the best growth stock to buy now equals the best small cap stock to buy then. But, I hope you caught that. But enjoy the rest of the presentation, and we'll be talking to you next week. Take care. Bye. Hi everyone, this is Matthew Connor with Connor Management Group, and this week we'll be looking at the best small cap stock to buy right now. Today is Tuesday, February 24th, 2015, and here on the opening slide we see that this company is in the railroads industry, and we see its 6-month upside potential at 34.0%. Not a bad amount. Going on to the second slide, and we see that the name of this company is called the Greenbrier Companies. The ticker symbol is GBX. The industry, once again, is railroads. And yes, to our own surprise, you don't think of railroads as having nice upside, but we see this company's upside, 6-month potential upside at 34.0%. On to the quick facts slide. We have a business summary for the Greenbrier Companies, and here it is. The Greenbrier Companies designs, manufactures, and markets railroad freight car equipment in North America and Europe. Its manufacturing segment offers double-stack intermodal cars, tank cars, Automax rail car, Multimax auto rack, and flat cars for automotive transportation, conventional rail cars such as box cars, covered hopper cars, center partition cars, bulkhead flat cars, and solid waste service flat cars. The company's wheels repair and parts segment provides wheel services, including reconditioning of wheels and axles, new axle machining and finishing, and axle downsizing, heavy rail car repair and refurbishment, as well as routine rail car maintenance and repair, refurbishment, and retrofitting of rail cars for third parties. And its third segment, its leasing and services segment, offers operating leases and by-the-mile leases for a fleet of approximately 8,600 cars. So Greenbrier Companies consists of three different segments: its manufacturing segment, its wheels repair and parts segment, and its leasing and services segment. The company's website is www.gbrx.com. The company's headquarters is located in Lake Oswego, Oregon. They were founded in 1974, and they have 9,244 employees. Onto the products and services slide. And what we have here is the Greenbrier Companies logo. And we have a couple photos of some rail cars, including some cars that could possibly carry oil or other chemicals. We have a photo of someone doing some welding in one of their shops. We also have a graphic showing their integrated business model, showing their three segments: manufacturing, wheels repair and parts, and leasing and services. Additionally, we have a map that shows their operations across North America, including some locations in Mexico, but they have quite a few operations throughout the Midwest, and I should say throughout the mid part of the northern and southern part of the United States, as well as quite a few operations on the West Coast, with just a few sprinkled here and there on the East Coast. Additionally, we have a graphic that shows the projected demand for North American rail cars and how it's expected to increase above the average for the next 4 years. And additionally, we have an excerpt from one of the latest investor presentations, and this excerpt shows management's highlights of the drivers behind their business. And what they've listed as the drivers are shale, oil and gas revolution, changing tank car regulatory environment. Another bullet is broader growth in intermodal, automotive loadings, commodities, and housing. Slowing rail car velocity. Aging fleet is another driver. And also another driver, strong railroad balance sheets and capital expenditure budgets, which is good for them since they are a rail car manufacturers. They don't run the rail cars, they simply manufacture them. Additional drivers are, especially for their wheel repair and parts segments, wheel demand is driven by stabilizing coal traffic, crude oil trains, and intermodal traffic growth. Increasing ton miles and equipment upgrades is driving repair spending, and they're approaching substantial tank car maintenance cycle. Additionally, they have here changing tank car regulatory environment, and there's also a graphic on here showing the strong projected growth increase for rail cars. An additional graphic and excerpt from the presentation is kind of a summary of their drivers. Basically, solid rail car backlog. They say that they have a very strong backlog of rail car orders. Diversified revenue streams, as we just mentioned, they operate in three business segments. Strong balance sheet, liquidity. The company's financials, which we'll get to, is solid, but they may also be referring to the strong balance sheet of the rail car operators that would order these cars manufactured by Greenbrier. And additionally, they have here listed as strategic initiatives that they're undertaking, highlighting initiatives that they're working on to improve gross margins and capital efficiency. So that's what we have for the products and services slide for Greenbrier. On to the metrics slide. What we have here is the annual revenue of the last 12 months for Greenbrier was $2.2 billion. The net income was $128 million, and the cash from operations was $96 million. The operating margins for Greenbrier in 2014, they were 10.8%, and for 2015, they're tracking to be 10.5%. I mean, that's effectively flat in my book. Onto the valuation metrics. The trailing PE ratio for Greenbrier right now is 16.4, and the forward PE ratio is expected to be 10.2, and that implies that analysts expect earnings to increase significantly over the next 12 months. The PEG ratio is at 0.9. Anything at 1 and less is usually a value bargain. The price to sales ratio is at 0.7, also a bit low. And the price to book is at 3.1. And the enterprise value to EBITDA ratio stands at 7.3. The dividend yield for Greenbrier, nothing to write home about, but it's something, is at 1%. And the average dividend payout ratio for the company is at 5.0% over the last 3 years. That's the average. On to the next slide, we have the price chart for Greenbrier. And basically, this shows that the stock for Greenbrier has already increased 45% over the past 12 months. 12 months ago, the stock price was around 40, and then 6 months ago, it topped out around $75 or so, and the stock has since then pulled back to around the $60 level. So the stock's had a strong increase. It's pulled back a bit from there, but we think that this is at a good entry point, and because of the projected strong earnings, we think that this is a nice value and a good opportunity to buy on this pullback from its high 6 months ago. On to the next slide, we have it. The title of the slide is called "The Why Now: The Bull Rationale for Greenbrier," and the main reason for why we see this stock as a buy right now is increasing sales and revenue. Greenbrier's domestic business, given some of our comments before, is expected to drive growth. Additionally, the company made an acquisition in South America, and they're expected to start to reap some of the benefits from that acquisition in South America. Actually, it was a partial acquisition. They made a 20% stake in a Brazilian-based company called Amstad Maxion. Amstad Maxion. So that's one reason for our optimistic look with Greenbrier, and additionally, it looks like they will have a low projected valuation metric, which implies it would be a good time to buy right now. So it's really two simple points: projected strong increases in sales and a projected low valuation metric into the future, which should be strong drivers for stock appreciation. On to the summary slide. What we have here is a look at some of the over high-level points for Greenbrier, and the financial statement quality we have listed as good. The company can manage its debt. The amount of debt they have due in the next 5 years is at $281 million, and right now they're projected to earn about, just say, around $200 million in profit over the next few years. So technically, they could take care of their outstanding debt over the next 5 years in 2 years. So we feel their financial statement quality we can classify as good. The operating margin trend, as we mentioned, is flat. The price pattern trend has been increasing. The stock's increased over 40% over the past 12 months. Our overall market outlook is somewhat bearish. We're just not seeing as many value opportunities as we have in the past. So that makes us a little cautious, but we don't expect this to be a particular headwind for Greenbrier. As mentioned, the recent closing price of Greenbrier was $58.65, and our 6-month price target for Greenbrier is $78.31, and this gives the company a 6-month upside potential of 34.0%. So it is for all these reasons that we believe that the best small cap stock to buy right now is the Greenbrier Companies. We hope you've found this presentation helpful, and we'll talk to you again soon. Take care. Bye. Hi, this is Mathis Connor from Connor Management Group, and I just want to take a few more minutes to give you some background about myself and Connor Management Group. First of all, if you enjoyed this podcast, and I hope you did, and you have been over the past few months or so, please write us a review on iTunes and Stitcher. We really would appreciate it, and it would help us get more subscribers. So that's something we'd appreciate. So for the podcasters out there, please go to Stitcher or iTunes. And for you guys on YouTube, I'd appreciate thumbs up and like, as well as just becoming a subscriber to the CMG Stock Picks channel. All right, well, that's what I wanted to say with regard to the podcast and YouTubers. Hey, try to be efficient. But I wanted to share a little bit about myself. Basically, I've been told from some friends and listeners that know me that I could enlighten my audience with a little bit more about myself. So I'm not all that comfortable with telling about myself. I really kind of want you to enjoy the content. But for those of you that have an interest, this is why the stuff is all the way at the end. So, okay. My name is George Mathis Connor. My background is that I have a bachelor's in mechanical engineering from a place called Rensselaer Polytechnic Institute, engineering school in upstate New York. A master's in engineering from Cornell University, also in mechanical engineering, and I have an MBA in finance from the University of Chicago. So hey, that takes care of my educational background. Basically, bottom line is to see, I did a lot of schooling. What my career experience has been to date. I started out my career as an engineer, did a few years of that. Worked on a lot of cool landmark renovation buildings in New York City for a few years. One of the most high-profile ones was my company, or I should say the company I worked for, was part of the renovation team of Grand Central Terminal. So for those of you that passed through there, I've spent a number of years in and out of every cranny of that building and facility. I also worked as a banker in New York after I got my MBA, and basically I worked on financing a lot of large-scale infrastructure projects, mostly power plants, but I worked on some basketball arenas as well, and some chemical plants, and even some coal mines. I've been deep down in the ground a number of times in my career. Additionally, let's see, after that, started working on the investment side of developing power plants, and particularly I spent most of my career with a company called Enron and another company called GDF Suez, where I worked on the development of power projects where where I acted as a equity investor for whether we were going to build them or buy them or sell them. And after GDF Suez, I am now an investment manager. And basically, I've been studying deals over the years, learning to build complex financial statements, always evaluating them, the cash flows, and making sure that these things will be profitable. And investing in the stock market was always a hobby of mine that I took more and more serious over the years. So after a bunch of time, I just, I'm really going to go after this. And so I spent maybe about, say, 3 years actually working on the development of some proprietary algorithms. I was just convinced that with my mathematics and computer background, coupled with all these financing deals, of which I became very good in with accounting and finance, I thought that I could at least find one way of consistently finding stock opportunities. So it was the development of these proprietary algorithms and me having some success with them that led me to the development of Content Management Group and the development of all of these videos and podcasts you've been seeing and hearing. And, I should say I am pretty happy with these algorithms. Basically, they review, analyze, and rank over 6,000 stocks every week. They're pretty comprehensive and pretty thorough. The algorithms use fundamental technical analysis and also consider some macro level measures. And another thing that's pretty unique is that these algorithms estimate future stock prices with specific time horizons. I haven't seen too many people on the web that will give you a potential stock price, say consistently say this is what we expect the price to be in 6 months, or this is the price that we expect there to be in 12 months. And I think for most of the videos and podcasts that I produce, you've always heard me give a potential stock price going 12 months out. The premium subscribers actually give them a stock price for the top stock prices for 6 months out. So that's about what I have to say about the algorithms. Additionally, about Content Management Group, our primary offering of CMG LLC is that we are a managed account service. And basically, a managed account, for those of you who don't know, is basically a more hands-on, customized way of investing for the long term. It's basically a complement or a supplement to a 401k or IRA and it has more benefits. And basically, you probably haven't heard of these as much or over the years because they've just become a lot more available to middle-class investors. And that's primarily because of advances in software for being able to handle many clients and move them in and out of custom portfolios and options. So if you want to know more about our managed account business, please go to ConnorMG.com. That's www.connormg.com, or you could go to our website and you can see a presentation that compares Content Management Group side by side with other managed account providers. E-Trade provides managed account service, Fidelity does, a lot of other mainstream firms. And like we said, basically now that the technology is advanced with software, it's a lot easier to manage. So basically, as with E-Trade's, a minimum size of account we open, say $25,000. And while as I'd say 10 years ago or more, minimum account size is probably $500,000. So there are a lot of changes, and you'll be hearing more and more about this account service, as time goes by. Additionally, additionally, you can get to know us through our social media footprint. Basically, we have a presence on all the major websites for your convenience, and there you can get a lot more articles and hear about different points of view on things going on in the market. So we have a presence on Twitter, Google Plus, and Facebook, as well as LinkedIn also. So you can be kept abreast for our thinking on stock investing, as well as things we share by others who we consider thought leaders. And finally, CMG offers 2 newsletters, both weekly, 2 weekly newsletters. One is to keep investors up to date about relevant news and provide in-depth analyses on a quality investment opportunity. And those opportunities are consistent with the free weekly podcasts and videos. And the other newsletter we provide is our premium newsletter, and that one provides the latest top picks from our proprietary algorithms that we run every week. So, feel free to go to CMG stockpicks.com and you can go there to subscribe to the newsletters. And if you go to the website, you can also view this deck and or any of the decks going forward, and there'll be a link there to everything I've just talked about. Basically, everything from the podcast to the newsletter to the presentations about our managed account service. So, hope this was helpful. Nice overview. Hope it didn't bore you. You can listen to this a couple times. That's why I put this at the end of the stock presentation. And I'll talk to you soon. Take care. Bye.